Hello and welcome to Aasgard Updates. My name is James Walsh and I'm the portfolio manager for the three strategies you can see on your screen here. This is the Coldstream Dividend Growth Large and Small Mid-Cap Strategies and the Aasgard Small Mid-Cap Fund. And I'm hoping that this channel will be a good means of communication for investors in these strategies. I get lots of FaceTime with our private clients, but I don't really get to interact with investors in these products very frequently. So I thought it'd be nice to have some means of regularly communicating with them on what we're thinking about in the current terms of the current economy and in terms of the current market, what kind of changes we might be contemplating. And so I thought this would be a great venue to do it. So I'm going to do some short videos and see how it goes. And hopefully this will allow us to communicate better, and you can stick comments and questions in there and I can respond to them over time. Caveat, this is not financial advice. This is not personal financial advice. The things that go into personal financial advice are myriad, and we need to know them all before giving any kind of personal financial advice. We need to know where your income's coming from, how stable is it, what other assets do you have on your balance sheet, what are the risks to those assets, are they correlated with the economy or not? And so that whole mosaic is very important when giving financial advice. So I encourage you to seek out a financial advisor and give them that giant clearer picture of your finances before making any kind of financial decisions. This is certainly not a solicitation for investment either. And also, these are my personal opinions. They are certainly informed by the wider group on our investment strategy team here at Coldstream. We have really brilliant thinkers, and the output of that group, of that investment strategy group, is generally the consensus view of the group, and it may differ from my own personal opinions, and that's okay. But if there's ever a question of what the firm view is, there should be no ambiguity, and the firm view will maybe or may not be reflected in these videos, in my personal opinion. And just so, if you hear from your portfolio manager or relationship manager conflicting advice, listen to them. is my only piece of advice on that. Well, let's get on with it. The topic of the day is going to be a review of the current market conditions. I want to look at where the momentum is in the market. Is it strong? Is it weak? Where is it? There's differences now. We want to look at the valuation. Where is the market cheap? Where is it very expensive? And maybe why? And what that means for future returns. And then lastly, we're going to look at the current economic conditions and see, what's happening with COVID and where we think the 2020 recession is going. And so with that said, let's move over here to my favorite stock charting website, which is stockcharts.com. Here we go. This is the S&P 500 for the last 3 years. The S&P itself is represented by these gray and red ticks. And you'll also see these smoother lines. This blue line is the 50-day moving average. It's the average of the prior 50 sessions. And the red line is the last of 200 sessions, so roughly a year. And what we're looking for on these charts is signals of momentum, right? Are we in a bear market or are we in a bull market? And a bear market has some characteristics, right? It's lower lows. When you get rallies, they kind of peter out as they hit these moving averages generally. Those moving averages become resistance. In a bull market's the opposite, right? You have a market's leading its moving averages. Moving averages are moving upwards. And when they decline, they tend to congest around those moving averages, and those tend to be buying opportunities. So if you're just a short-term trader, you can pretty reliably use these things to make a little extra, right? Now, they're not perfect indicators. They're not even, I wouldn't even consider them long-term indicators. They're really actually very short-term indicators, right? And not fundamental. And they're not always right? Technical analysis is right most of the time. So the things that we kind of glob onto are things that generally work, but not always. And so like one of those things is what we call a golden cross or a death cross. Those the opposite term. So a death cross is when the 50-day moving average in the S&P 500 crosses beneath the 200-day, like we saw here in late 18. And that preceded a bigger decline, right? So a death cross, further decline is usually the story. Now, that's not always the case. We got another death cross here in, was it late March? Now, that was well off the lows, right? So had you gone short on the death cross, you would have lost a lot of money as this market's appreciated. So these are rules of thumb. They're not laws. So take it with a grain of salt, as you should any kind of financial advice. Any of these kind of technical analysis kind of pieces. But in general, the S&P right now is exhibiting behavior of a bull market, right? We had a bear market, right? We had these declining, horrible days. It was a panic. I would classify it not even as a bear market, it's just a straight up panic, and then a very rapid recovery. I'll go into the kind of what I see as the reasons for this rapid rise, but albeit this is a dramatic decline, dramatic recovery. I don't think the market's ever, the S&P at least, has never moved this fast in both directions in this short period of time. But in the short run, right here, where are we at? You see the S&P bounced hard off its 200-day and been appreciating ever since. We've got this golden cross, the 50-day crossing the 200 in a positive fashion, and the market's making new highs. So on balance, if I had to characterize it, I would say this is a bull market. You should buy dips, right? If the market dips for some temporary reason, comes down on its moving average, you'd be more inclined to buy. Hitting new highs, maybe you hold them a little bit longer than you expect. And that's the shape. But underneath the hood, it's a little bit different. So if you look at, this is the Vanguard Growth Index ETF, you divide the market in half, and you have the most expensive, fastest growing companies on one half, and the cheapest, least expensive companies on the other half. You get this bifurcation. You get this growth index, all the fastest growing companies. This is a beautiful bull market. This is broken out over its all-time highs back in February. It's this nearly unbroken trend, which obviously, I mean, that terrifies me. I don't like chasing a move like this, but there is nothing on this chart that says, man, you need to short the market right here. Like this is, I feel really bad for like investors that have been short Tesla, right? I mean, they're just getting annihilated, but for 5 years now, because, just, you might not want to bet against this momentum. The trade is definitely on. Investors really want growth stocks at this point. I get it all the time. I've got quite a few clients that have called me up and say, hey, I'm really worried about the second half of this year. Sell my stocks, but maybe keep just Microsoft and Amazon and Apple, And so I understand it, because fundamentally, there's always a fundamental truth, or an element of truth. I mean, the element of truth here is that these companies are growing their market share. They are growing revenue because of this recession, right? Amazon is capturing more market share because people are not leaving their homes. They're ordering things online. So that's happening. I'm working from home. I'm recording this from home. I'm now using the tools, productivity tools, more intensely than I ever have. So you can kind of get to why these companies are appreciating in the manner that they're appreciating. Now, there becomes a point, though, where the stock price appreciation far outstrips the fundamental change in business conditions, right? So the revenue is growing at, great, it's growing at 10%. The stock price is up 70. Is that justifiable? And that's where you get into the valuation analysis, and you really got to dig deeper and really do some more fundamental analysis on the company itself and whether or not those prices are justified. I would say in general, there's a lot of companies out there that are trading at valuations that just don't make sense. And we've seen this before in 1999, where tech companies got very, very expensive. And I understand it. It feels good. You bet on some company and it wins. And so this is why momentum works, right? When you bet on a company and the stock price goes up, like, oh man, I'm smart. I'm going to do more of that. And that behavior begets more and more of that behavior until some inflection point that causes it to change. And the inflection point in 99 was higher interest rates and basically inducing a recession. We don't have that situation today. Interest rates are extremely low. So I don't know what's going to cause this momentum to break. But if I was a short-term trader and just using momentum, I would not be betting against this at this point. Like, there's just nothing in this chart that says, hey man, I should take money off the table. And then you get to the other half of the market. This is represented by the value index. And this looks like I would expect the stock market to actually look, given the fact that we're in this recession and we have such high unemployment. And there's all kinds of boogeymen out there for the second half of this year in the form of COVID, the resurgence of the virus, and the upcoming election, and the potential for it to be contested, and just uncertainty around what are taxes going to be next year, and like this is, I mean, it's a bit of a mixed bag, but this is still kind of a bear market chart. You can see the value index hit its 200-day, false breakout, failed, rallied a bit around its 50-day. It's been able to hold its 50-day out ever since, and now we're kind of in this congestion zone. I'm not quite sure how this is going to resolve. I do think, you know, on a short run, you know, I wouldn't be making any kind of trades around this because of the congestion zone, because it's either going to break higher or break lower, and there's, you know, nothing on the chart is going to indicate one direction or the other. I think it'll be more fundamental based. It's petered out here in June simply because, you know, if you look at the COVID stats, you know, Florida, Arizona, Texas, even California, they're all seeing rising cases and rising unemployment because of those cases and the lack of economic activity around those states. Now, if that means other states have to go through this, you know, you can kind of get this kind of sine wave of expanding economic activity and then contracting economic activity as we go through fall and the next, well, foreseeable future until we get some sort of, you know, either COVID blows itself through or we get a vaccine and there's some sort of immunity. But these are the economically sensitive stocks in this index, right? These are the banks, these are industrial companies, these are, you know, even utility companies are having a rough time, real estate. And so they are still trading at, I would consider, you know, cheaper prices, and, you know, based on the chart, is kind of a ugly kind of bearish market, but it's not a hard bear market because it's not beneath its 50-day. It's actually recovered quite a bit. Now looking at the small cap market, this is the Russell 2000, which has been essentially a bear market for 2 years. It peaked back in late 18, crashed in late 18, came back, rallied up into January, February of this year, and then fell off for the rest of the market. Has not yet quite recovered, but we have seen a really big move off the lows here. And again, when you kind of look underneath, a lot of the move is these smaller tech companies are what are pushing this thing up, and biotech also. So smaller biotechs, these are generally companies that have no earnings, are the ones that are pushing this market higher. Your industrial companies, your local banks, your real estate companies, they're all still under distress. And so if you go down another layer, there's quite a few companies that are still exhibiting, you know, recession pricing, your airlines, your casinos, that kind of thing. But in general, this chart actually looks pretty decent. We're up and above our 200-day. We're about to get our golden cross moment here in the Russell 2000. That's probably a pretty, you know, positive inflection point, the fact that it's breaking out from here. And then you've got your next level of resistance would be at this kind of 165 mark on this index. So a bit of a mixed bag, but the short of it is the S&P is in the bull market now, despite everything that's gone on the ground. It's a bit, you know, mystifying, but it is, you know, the charts aren't lying to us. It's in a bull market. It's particularly tech. It's very narrowly focused on tech, but, you know, some other industries are bubbling up as well as we move through the year. So now I'm going to change my screen to some charts from our chart deck that we put together every quarter. And this is the Coldstream ISG chart deck. Thank you, Blake. Anyway, what we're looking at here is through June 30th, the price appreciation of the 5 largest stocks relative to the S&P itself. So this is how narrow the market is. You've got Amazon here. Sorry, wrong chart. Here we go. It looks like the one I wanted. Keep in mind, I'm only doing one take of these things. I'm no post-production, no editing. You take all the fun out of it. Anyway, we got Amazon here. Amazon as of June 30 was up 50% for the year, which is staggering. That's a big move. Microsoft 30%, Apple 24%, Facebook 10, Google 5, and the S&P at that point was still down about 3%. And of course, this has only gotten more exacerbated since then. So very small number of companies leading this market, and kind of euphoric. Now, the reason this can be concerning is when you look at past history, particularly like 1999, we saw a similar kind of concentration, and this also happened in the Nifty 50 kind of era back in the 70s. So when you get a small number of companies that are just dominating the market, the forward returns from that point forward tend to be muted. So if you bought tech stocks, you know, in March of 2000, you made no money for a decade in those things. right? If you bought Microsoft and Apple and all these great companies at the wrong price, you paid the price over the next decade. And so what you're looking at here is the concentration. It's the top two weights of the S&P. So right now it's Microsoft and Apple. And they are both 6% of the S&P 500. Last time we had concentration like this was 1999. And so you can buy a fundamentally strong business that's growing its market share, it's doing all the right things, but you can pay too much for the thing. And at some point, investors rationalize what they want to pay, and their preferences change. And when their preferences change, for whatever reason, in 2000 it was higher interest rates, it changes. And you can be stuck with a dog. I mean, Microsoft grew its earnings and revenue, double digit year over year for a decade, and the stock price just got cheaper and cheaper and cheaper. I mean, it went from a 40, 50 PE to 10 over a decade. And investors made no money. And now, of course, the business conditions have changed, investor preferences have changed, but you are at the whim of another investor willing to pay just that much more for a company that is very expensive. And, it's all relative, right? There are other companies that are trading very cheap right now. You go look at, JP Morgan or American Express, like, yeah, those, banks are going to have a tough time. It's recession. But man, if you can be patient, if you got 3+ years, you can pick up a company at 10 times earnings, 12 times earnings, and make a great, fantastic forward return. So on this chart, what we're looking at here is the S&P 500 PE ratio at 21. And then we have the growth PE at 28, and then the value PE at 15, 16. Now, this divergence between growth and value is about as wide as I've ever seen. Even in the bubble days, it wasn't nearly this wide ranging. But investors clearly have a preference for tech. I mean, I guess they feel it in their bones and they see it in their day-to-day lives that they're using tech more. And so they just want more of it, and they'll pay any price for it. Like I said, the worry here is that you pay too much, your forward returns from this point forward are muted. And if you look back in history, had you bought a 28 PE market, you make no money for the next 7 to 10 years. Now, if you buy a 15 PE, on the other hand, you're putting the odds in your favor, because somewhere in the future, we're going to have another economic expansion. And then, your JP Morgans, your American Expresses of the world, they're going to make a lot of money. And you'll be glad you paid 15 times earnings for them, because their PE ratios will appreciate. They'll go from a 15 to a 15 to a 20. And so that'll be a tailwind for your stock performance, right? It's not just that the company earns more and grows faster, it's that they get a multiple bump. And right now the multiples are low because, for the obvious reasons, that their business conditions are rough for the foreseeable future. But if you're patient, and I'm patient, I like to be patient, I want to be patient, and you can pick up some bargains right here. And so on the margin in the strategies, what we're doing is, when we get outstanding excess return, when you see a stock move 50, 70%, in a 6-month period of time, you can take some of that excess and they go out bargain hunting. And that's exactly what we're doing. So we're taking out the excess when they're given to us, and we're buying what we believe are durable companies with durable balance sheets that will survive this recession, that will eventually grow their market share through this recession, hopefully, and expand into the future when the next expansion occurs. And so that's the state of the valuation. Now let's go to a more fundamental analysis of the economic condition. I'm going to do a new share here. Going over to back to my browser. Now, if you're a client of mine, I apologize because you've seen this a million times, but this is my favorite read, easily to digest measure of economic activity. That's put together by the Conference Board, which is a nonpartisan, nonprofit organization of economists that are really just tasked with measuring and observing the global economy. And they've got this index, a few indices actually, to be precise. They have the leading economic index, and that goes back to the 60s, and it is predicted reliably recessions that we've had. And it's composed of things like unemployment claims, orders for durable goods and consumer goods. It's got housing starts. The S&P 500 itself is in there. And those things tend to precede economic growth or contraction. And generally, in a normalized recession, those measures would be predictive, right? And the difference is not all recessions are the same. Now, a normal recession is there's some economic activity. There's a product or service that is expanding, and a lot of companies will jump in to compete for that new market, right? And they'll overbuild their capacity. They'll build factories to build the widget. They'll hire a bunch of people and salespeople and all that kind of thing to chase after it. But eventually, the market gets saturated with said widgets. And when that happens, you have an excess capacity problem. And people have borrowed money to build factories and expand, and there's just not enough market to go around for all these entrants. And so what you get generally in unison is everybody cutting capacity at the same time. They're slashing their workforces, they're closing these factories, they're defaulting on their bonds because they can't pay them, and that kind of thing. And that all happens at once. That's a normal recession. And then you get the meteor from the sky, or a pandemic. And that's what we have today. We have basically a recession by fiat. The government's, in response to the pandemic, basically ceased all economic activity in unison in the United States, and we had a 30+% annualized GDP decline in Q2. That's rough. And since that time, many states have been opening. Everyone's at different speeds, but that's the shape of this recession. It was not going to be predicted by payrolls or housing starts or any other kind of economic measure, because it's a true kind of call it a black swan. People could have predicted a pandemic would eventually happen, but the timing of which is always going to be uncertain. And certainly the policy response, the idea that we're going to just socially distance by federal well, not federal regulation, but state and local regulation, but was never really on the table. I don't think anyone's ever kind of contemplated that before. At least I haven't. And so we got this massive decline in economic activity, and the LEI and its friend, the coincident indicator, that's the red line there, they both are just straight lines down. And so we are nowhere near the economic activity that we had back in 2019, but you can see there's a little bit of recovery. This is the June report, and so we've got 2 months of recovery in there. Now, we're going to be in recovery until those measures go all the way back to where they were, and that's going to be on the backs of payroll growth and orders for goods. But if you look at the stats coming out right now, this is August 5th, look pretty good. They're going in the right direction. The only one that is worrisome is the high number of continuing unemployment claims and the growth in permanent job losses. And so basically how I would read these things right now is that generally we could actually try to trade on them, right? If it was a normal recession and the LEIs were declining, we'd play defense as they were declining, and get more defensive with the portfolios. And then if they were expanding, you'd say, oh, okay, maybe get more bullish, a little more beta, a little more growthy. But they're not terribly helpful right now, because the variables that are going to affect the economy going forward are essentially unknowable, and we are admitting that they are unknowable. I mean, the course of this virus is an unknowable value, right? We do not know if things are going to improve from here or get worse. And I've heard arguments for both. Both are, in my opinion, equally valid. And because I don't know the future, I will not bet or wager my investors' money on said estimated future. And so what that means is essentially we're going to play defense. But what I'm looking for to get confident is going to be an increase in payrolls, and a durable increase in payrolls. I want to see job growth for, call it 3 to 6 months from now, probably. Right? I know we're gaining jobs right now because the temporarily unemployed are returning in some sense, but the permanent share of job losses is continuing to increase. So what I'd probably like to see is the total aggregate payrolls increase, while the permanent share would also need to decrease over call it a 3 to 6 month period. And that puts us into January, February of next year. So I'm not saying these measures are garbage, but they're not terribly useful for the next 6 to 9 months. But generally, they'd be very important to us in determining how we want to behave. Now, the economy's been backstopped by the federal government, right? We've got, the PPP and the income replacement has been robust. The CARES Act was robust in terms of getting money into people's pockets, right? And so that helped a lot. I mean, that helps explain where we've seen the stock market move to date. I think the bigger influence and probably the primary influence on the stock market right now is Federal Reserve policy. They have instituted quantitative easing and reduced the overnight interest rate to 0%. This massive quantitative easing pushed a lot of liquidity into the market. And basically what they were making the determination that they don't want another 2008, right? So generally speaking, in a normal recession, when capitalists allocate too much money to an unprofitable idea, they don't want to bail that out, right? They want that bad behavior, in quotes, to be punished. This is a little bit different. This recession was induced by government, and I mean, the pandemic itself had happened, but the government response was to shut down the economy and say, "Hey, man, we need to do something quick to backstop this economy." And so they did. They rolled out the big guns. They've essentially monetized all of the newly issued treasuries and then some, and they've gone out and they've actually bought corporate bonds, and they've indicated that they will buy municipal bonds as well to put liquidity back in the market. And so every time they do that, they're pushing people out of those assets, right? So someone owned a treasury, got bought by the Federal Reserve. They now have $1. Like, what are they going to do with it? And so I think a lot of that money's found its way into high quality companies, right? That are no-brainers, right? A lot of that money has been pushed right into the tech market, in the stock market, right? And so you have asset price inflation. Well, asset price inflation is probably the least bad outcome, right? You can have a bubble. All right, we can probably deal with that. But the alternative was, hey, we're going to go into depression because of this. And so I'm glad the Fed did what they did. There are adverse consequences to it, but I think it's it's the lesser of evils, at least to date. Eventually, I think a lot of the criticism will be that this will turn into inflation, but they haven't been able to stoke inflation since 2008, and the technology curve keeps pushing the cost of production down, and labor costs continue to be moderate in terms of like price increase and labor cost increases. And so we just don't have a lot of inflation. But curing inflation would actually be pretty easy. They have a book for that too, a game plan for that, and that's just simply to raise interest rates once it happens. But so far they've indicated that they're going to keep interest rates low probably through 2022, and they're going to backstop this economy. And so I wouldn't really bet that the market's going to crater or crash, because there's a lot of liquidity pushing into this thing. And I really, as the old adage goes, don't fight the Fed, right? When the Fed is pushing money into the markets, why would you want to swim upstream and fight against that? It's much easier to go downstream and just, okay, well, that's where the money's going, just follow the momentum. And so, at the margins, what we're trying to do is when the market gives us excess, we're taking those gains, right? When we see these giant moves in these stocks, we're taking the excess and we're going out and we're bargain hunting. And there's a lot of bargains out there, I'll tell you. I mean, you look under the hood, there's a lot of good, well-run companies that are quite solvent who are having temporary distress because of the recession. But I assure you, at some point in the future, we'll be in another economic expansion. COVID will have passed. We'll be on to the next kind of thing to worry about. But people right now are putting together their business plans. They're creating new markets. They're creating new products and services, and they're getting funding, and they're going to roll those services out, and people are going to buy them. And because that's what people do. We get up in the morning, we're productive, and we create things and we consume things. And so as long as that dynamic continues to hold, I am bullish, and we'll say there are companies that are in temporary distress. Those are the ones you want to take advantage of right now. And our viewpoint is that those are going to be the real winners coming out of this recession. And try not to get too starry-eyed with all the tech stocks and how fast they're moving right now. I don't think their forward return looks all that attractive at this point. So if you enjoyed this, please give me a thumbs up, subscribe. I'm going to try to get some of my colleagues on here and some other people I can interview and try to make this interesting. I'll also try to make it just a regular feature and hopefully get good communication with our investors. And so if you have questions, I mean, I can't get too specific on, what stocks I'm repicking and that kind of thing. But if you have general questions about the economy or what we're thinking about, please include them down below, and I'll get to them on the next round. So thanks for sharing your time with me. I really appreciate it. Have a good one.